Alibaba has a cash position of over $85 billion. If we subtract the current and non-current debt and borrowings, we end up with almost $62 billion in net cash. If you combine net cash and retained earnings, that's $147 billion on a market capitalization of $195 billion. So there's plenty of potential to buy back shares or pay dividends in the future. Actually, Alibaba started both in recent quarters. In terms of cash flows, Alibaba generated $25.3 billion of operating cash flows from Q1 of 2023 to Q1 of 2024, of which $20.8 billion came out as free cash flow.
Hello! Before we dive into the video, be sure to click that subscribe button so you never miss an episode. Show us some love by giving a thumbs up and sharing your thoughts in the comments. Your support really means everything to us.
Let's jump straight into it. If you've been in the markets for a little longer or you're just familiar with the Alibaba situation, you will know that an analysis will inevitably involve a look at the political tensions and developments of recent years. As value investors, we usually tend to focus on the company level and less on macroeconomics. But as mentioned, Alibaba has proven that there are investment cases in which neglecting macroeconomic factors can be costly. Sometimes the impact is simply too big to ignore. The most important factors in the Alibaba case, and generally all Chinese equity cases, were China's attitude towards their largest tech companies and capital markets as a whole, the slow recovery from COVID that resulted in weaker than expected growth rates, and geopolitical tensions with the US and Taiwan. But before we get into the details of this, let me break down Alibaba's history again, because I think knowing where it came from and how fast it became the Chinese company helps us understand a lot of what comes later. Alibaba was founded in 1999 by a group of 18 people led by the former English teacher Jack Ma in a small apartment in Hangzhou. As we all know, a humble beginning in a small apartment or garage seems like the perfect setup to create something big. Accordingly, Alibaba came at the perfect time. The Chinese middle class was among the fastest growing in the world, and the gross national income per capita has increased tenfold since 2000. This fueled the consumerism of Chinese households. The global rise of the internet and online marketplaces also opened new opportunities in China. Another advantage was China's relatively isolated position in the global capital markets. While the dot-com bubble severely impacted American and European companies and consumers, Chinese companies faced relatively little consequences. One can say that Alibaba was at the right place at the right time. This was also noticed by investors. Alibaba collected $25 million in funding from American banks such as Goldman Sachs or Fidelity, and other big investors such as the Japanese holding company SoftBank. Initially founded as a business-to-business e-commerce platform, Alibaba connected small and medium-sized Chinese suppliers, global buyers. In 2003, however, Alibaba expanded its business model with the launch of Taobao, a consumer-to-consumer marketplace that quickly gained traction and permanently revolutionized how the Chinese middle class consumes. Taobao is similar to eBay, but it offers many functions that we don't know from eBay or other US or European online retailers. These features include image search, live chats with sellers, and small online games. It didn't take long until international customers became interested in Taobao's product. Even today, Amazon users often buy products originally offered at one of Alibaba's marketplaces, without even knowing it. It has become quite a common practice for Amazon sellers to buy cheap products from Alibaba and resell them for profit on Amazon. Some of these products are resold at 10 times the original price on Amazon. Accordingly, it only made sense to buy directly from Taobao or other online places instead. To improve the buying experience for international customers, Taobao integrated translation and logistics services that made the buying and delivering process as easy as possible. Nevertheless, more local e-commerce platforms still perform better due to regulatory and cultural aspects. That's why Alibaba later decided to expand with more locally targeted marketplaces in different regions. We'll get back to that in a minute. To this day, Alibaba's biggest revenue, profit, and cash flow generator is the Chinese e-commerce market, covered by Taobao and Tmall. Nonetheless, Alibaba has continually expanded its ecosystem and diversified its business portfolio. In 2004, they launched Alipay to be independent of other financial transactional services. 10 years later, Alipay was renamed Ant Financial and eventually Ant Group, a company that will play a major role in today's episode. The same year, Tmall, Alibaba's business-to-consumer marketplace, went global and became one of Alibaba's first steps into expanding into international markets. Although it's not Alibaba selling goods in other countries, instead, non-Chinese companies could now sell through Tmall to Chinese consumers. Since 2014, Tmall Global has gone from 100 international brands on its platform to over 46,000 from 90 different countries. Another business segment is Alibaba Cloud, which will be another main part of today's episode. It was established in 2009, but only started to gain traction a couple of years later when the overall cloud market started growing, especially in China. Alibaba Cloud quickly grew to become China's biggest cloud provider and the driving force for innovation in this space. It is still dominating the cloud market with a share of 39%, but competitors are catching up, especially since Alibaba's cloud growth slowed down significantly in the last 2 years. Another growing part of Alibaba's ecosystem is its 2013 founded logistic arm, Now, which started as a joint venture between a number of delivery courier companies and Alibaba as its biggest shareholder. In 2017, Alibaba acquired a controlling share of 51%. Since then, Alibaba's stake has increased to 64%. And in March of this year, they announced their plan to buy the remaining 36% of Now to gain full control of the company. This decision was made after the original plan to spin it off and thus create value for shareholders was put on ice due to the bad sentiment that would have probably resulted in just another low valuation. This decision was made for all segments that were initially planned to IPO this year. Now isn't a typical delivery company since it does not engage in the physical delivery of packages. It's a logistics service integrated into Taobao. It simplifies the package ordering process for consumers by choosing the best courier company, delivering details like the parcel pickup times and real-time tracking. Now also has a chain of Now pickup stations. They're like little post offices in which clients can pick up packages that couldn't be delivered to their homes. For merchants, Now offers productivity gains by utilizing the data to improve the warehousing and delivery process. Now also runs warehouses in strategically important locations where merchants who lack warehouses in these regions can store products to speed up the process and ensure timely delivery. The main benefit for delivery companies is the optimization of routes enabled by the large volume of orders. Alibaba also decided to increase its global presence beyond the scope of Tmall and Taobao by building up or buying up international e-commerce marketplaces. Originally integrated into Alibaba's ecosystem as International Digital Commerce, the business section is now called Global Digital Commerce Group. I mention this in case you want to research Alibaba yourself and get confused by the often changing names of Alibaba's business section. Generally, with the latest restructuring in 2023, many of the business sections get renamed and some businesses, mostly small ventures, switch categories. But this didn't change much, if anything, on the business or operational level. The global e-commerce of Alibaba operates via different marketplaces, each targeting a distinct geographical market. The four marketplaces are AliExpress, which has become a big player in Russia. The global e-commerce of Alibaba operates via different marketplaces, each targeting a distinct geographical market. The four marketplaces are AliExpress, which has become a big player in Russia, Lazada, whose main customer base sits in Southeast Asia, Trendyol, which is focused on the Turkish market, and Daraz, which is another, in fact, the biggest player in the South Asian market, the dominant position especially in Pakistan and Bangladesh. Combined, these marketplaces reached 214 million active annual users last year, up from 180 million in 2022. Regarding Alibaba's revenue share, Alibaba Cloud, Now, and the global e-commerce segment as a whole contributed an equal share of around 11 to 12% of the annual revenues in 2023. Over the course of this episode, we will get into more details on each of these segments, but first let's take a look at Alibaba's stock development in recent years. Shawn, can you paint a picture for us here?
Sure. Alibaba's stock has been China's poster child for many years, basically since its IPO in Hong Kong in 2007, and even more so after its New York IPO 7 years later in 2014. It was one of the first Chinese stocks that drew major international attention, and its New York IPO raised $21.8 billion at a valuation of $168 billion, making it the world's most valuable tech IPO. On the first day of trading, the stock immediately gained over 40%, going from a starting price of $68 to $96 per share. For comparison, Facebook's IPO, which raised $16 billion in 2012, had held the record for the highest valued tech IPO until Alibaba came along. Alibaba's success story continued for over 6 years, and it became the second most valuable Chinese company, reaching a market cap of $858 billion in October 2020. Unfortunately for Alibaba shareholders, this marked a top that seems unreachable. Looking at the stock chart today, Alibaba is currently trading at a market cap below $200 billion, resulting in a stock price of $80 per share, which is $16 cheaper than it was at the end of the New York IPO 10 years ago. Despite these stock prices decreases, Alibaba's outstanding shares have decreased by 100 million compared to the share count back then.
There's truly been a frustrating journey for Alibaba shareholders. Many of them come from the value investing community, since it became quite a popular contrarian investment, and yes, there's an irony to that. This was fueled by Shawn O'Malley, who started heavily investing in Alibaba back in the first quarter of 2021, back then at a price of well above $200. He later referred to his Alibaba investment as follows. This is quite the statement, and it led a lot of investors confused, since the original thesis of buying a fundamentally strong company that is unloved by international investors for mostly regulatory reasons was seemingly still intact and potentially getting stronger the lower the stock went. Mahncke also said that he missed the fact that Alibaba, in the end, was still a, quote, damn retailer. I can understand the investors' confusion with these statements by Shawn O'Malley. Alibaba's business model is pretty straightforward. Despite its many ventures and business segments, what is relatively easy to see is that Alibaba remains very dependent on its core business, Chinese e-commerce. And this is an easy to understand business model and market. It seems unlikely that Mahncke misjudged the nature of this business, especially considering his conviction and position sizing when he entered into Alibaba. And after analyzing Alibaba's business, I do not think that its main problem has been the retailing business. Yes, more competition, a weak economy, and lower than expected competitive advantages did reveal weaknesses of Alibaba as a retailer. But I consider other factors more important in Alibaba's recent downturn. But before we get to them, let's take a more detailed look and see what changed in Alibaba's core business in the recent years. As mentioned, Taobao and Tmall are Alibaba's cash cows. Over the last year, they were responsible for over 46% of revenues, and even more important, they were responsible for 118% of profits. And while this might sound unintuitive at first, there's a simple reason for that. Since many other segments of Alibaba are still loss-making, Taobao and Tmall are basically subsidizing their losses. The Taobao app has over 920 million monthly active users, and Tmall has another 850 million. For comparison, Amazon only has an estimated 310 million. All of these users result in a combined market share of Taobao and Tmall of somewhere around 40% of the Chinese e-commerce market, which is by far the largest in the world. With over $3 trillion in annual e-commerce sales, the Chinese market is responsible for more than half the global e-commerce sales. Part of the truth is that Alibaba used to have a market share that was significantly larger than 40%. In 2019, the market share was around 68%. However, more than natural that a market share of 69% is not sustainable in what is one of the most profitable markets to be in. Competition was inevitable, and as we've seen in Alibaba's history, they had a first mover advantage. But in a functioning market, a first mover advantage will, at best, result in a head start. Competition will get into the market and they will gain market share eventually. And since these dynamics were already in full swing when Alibaba was still the celebrated Chinese tech company in the eyes of international investors, I find it hard to believe that this is the reason for Alibaba's stock decline. Instead, the reason for Alibaba's problems have been quite obvious in recent years. To break this down, let's take a look at the timeline of Alibaba's downward spiral. Alibaba's stock price decline started when the Chinese government initiated a series of regulation on its national tech giants. With Alibaba as the best known and biggest player in the industry, it was at the forefront of this regulatory breakdown. It all began in November 2020, when Chinese regulators called off what would have been the largest IPO in the world, raising an astonishing $37 billion. This was the planned IPO of Ant Group, which would have valued the company at over $300 billion. Ant Group was also founded by Jack Ma, and Alibaba has and still holds a 33% stake in the company. Thus, the IPO would have added about $100 billion to the sum of the parts valuation of Alibaba. Accordingly, investors received the cancellation of the IPO very negatively, initiating not only a series of regulations, but also a change in the narrative regarding Alibaba and Chinese stocks as a whole.
That's right. What didn't help the overall sentiment was the reason for the sudden halt of the IPO. While the official reason was that there had been, quote, major issues at the company, the market didn't buy that and suspected that a recent speech from Jack Ma, critical of the government, was the real reason. The stock reacted with an immediate plunge of 9%, and instead of recovering in the following weeks, Alibaba ended the year with a 25% decline. Since then, the stock has been repeatedly hurt by bad news and has gone down a spiral of falling stock prices and new bearish news. Only a month after the Ant incident, China's leading political party, the CCP, announced that it would prevent the, quote, rampant accumulation of capital and limit the influence and size of the Chinese internet industry. This was followed by an official antitrust investigation into Alibaba, which eventually resulted in the first financial fine of this regulatory crackdown.
Correct. All the regulations and announcements that we've discussed until now only, if one can even say that, hurt Alibaba's reputation and thus the stock price. But they didn't create any negative cash flow. This changed in April of 2021, when Alibaba had to face the first tangible fine of $2.8 billion. A record fine that amounted to 4% of the 2019 revenues and has been another sign to investors and competitors that the Chinese government is willing to hurt its biggest companies. The reason for the fine was the supposed abuse of its market position since 2014, mainly the practice of forcing merchants to choose between platforms instead of working with multiple marketplaces, the so-called choose one policy. If they want to sell on Alibaba marketplaces, they are not allowed to sell on any other sites. However, it's interesting to note that the market perceived this fine very positively. After the fine was announced, Alibaba's shares in Hong Kong climbed by 9%. Investors thought that this would be a good sign because it implies the end of the CCP investigation into Alibaba. With all the rumors about how bad the regulation could get, a $2.8 billion fine looked like a good ending compared to what could have been possible. Unfortunately for Alibaba shareholders, this positivity didn't last long. Although Alibaba increasingly disappeared from the CCP's crosshairs, the regulation and fines of other Chinese companies continued to worry international investors and caused massive losses for the entire Chinese stock market and, accordingly, also Alibaba. The most severe impact was the regulatory intervention against the Chinese mobility platform Didi. Only a couple of days after Didi IPO'd on the New York Stock Exchange, the Chinese cyberspace internet regulator started an investigation and disallowed Didi to register new users to its mainnet. At the end of the 1-year-long investigation, Didi had to pay a fine of approximately $1.18 billion. Once again, the financial fine was not the biggest problem. The severe losses Chinese stocks had to take were mostly caused by the uncertainty around international listings of Chinese companies. Suddenly, there was a huge debate about the VIE structure of Chinese stocks and the possibility of a forced delisting of those stocks. VIE stands for Variable Interest Entity, and it's an investment structure used by Chinese companies to enable foreign investors to buy their shares, which has not always been possible. It is also used by Chinese companies to enable public listings outside of China. Under the VIE structure, the operating company is owned by Chinese shareholders who act as nominees for foreign investors. This allows the foreign investors to take part in the economic benefits of the operating company pretty much exactly as if they would own the stock directly. This structure has been used without any major problems since the 1990s and early 2000s. The Chinese government accepted this practice and dozens of companies used it to collect money or list abroad. But every now and then, mostly when it fits the general sentiment, it becomes a topic, Investors fear that the structure could be reevaluated by Chinese authorities and claimed as illegal, resulting in a loss of their shares. This also became the dominant narrative from the second half of 2021 to at least the second half of 2022. Within this time frame, Alibaba lost another 60% of its market value. I think this is where we can discuss the last important regulatory incident. And it's kind of a full circle moment. We end where we started. In July 2023, 2.5 years after the called off IPO, Ant was fined close to $1 billion for corporate governance and financial consumer protection. Once again, this financial fine was rather well taken by investors since it suggested the end to the investigation and regulatory breakdown. After almost 3 years of uncertainty, what remains for Alibaba are fines close to $3 billion, a stock price decline of around 75% from its all-time highs, and a seemingly permanently damaged attitude towards the Chinese stock market. This might be the main problem for Alibaba going forward.
Absolutely. If we take a look at the capital inflows and outflows into Chinese markets from global investors, the picture is pretty clear. While capital inflows increased year by year from 2017 to 2021, with the exception of 2020 due to COVID, 2022 and 2023 are only a fraction of the 2021 inflows. In absolute terms, in 2021, over $65 billion worth of Chinese stock was purchased by global investors. In 2023, this number decreased to roughly $7.2 billion, which is a decline of 87%. Trust in the Chinese market and, above all, the Chinese government has vanished, which is just a major problem for Chinese equities. From a fund manager's perspective, holding Chinese equities has not only resulted in poor financial performance, but it also comes with a huge reputational risk and the constant need for justification from investors.
The so-called career risk, which basically describes how deviating from the crowd can cost an asset or fund manager his job when he proves to be wrong. Being wrong while going with the crowd is no reason to fire anyone, since everyone is in the same boat. But betting on a different horse and losing is a very bad look. Investors lose trust and withdraw their money, and the manager becomes untenable for the company. Dynamics like these are fueling both boom and bust cycles. Professional investors cannot invest in what they think is the best opportunity. They are limited by their clients and thus forced to make the same mistakes as their clients. Selling when the sentiment is bad and prices are low, and buying when the sentiment is good and prices are high. That's one reason why Alibaba's attractive fundamental valuation has not gained any institutional attention. However, besides the reputational damage and implications for institutional holders, there are also fundamental reasons for the failure to recover.
How do you get started with stock investing? I've put together a course to teach you everything I wish I knew when I first started investing in stocks. Let's start at the beginning and ask, what is a stock? Let's zoom on into what it's actually like to buy a stock. A few options are Charles Schwab, TD Ameritrade, Ally, E-Trade. Fortunately, you won't have to necessarily calculate all of these taxes yourself. I'll outline a few main ones to be aware of throughout your lifetime investing journey. As Warren Buffett says, your best investment is yourself. There's nothing that compares to it. By the end, you'll be savvier about stock investing and personal finance than the vast majority of people. Even if you're not a total beginner, I'm confident you'll get a lot out of the principles and strategies I outline, which we'll build on throughout. A link to the course is available in the description below. See you there.
I would categorize these into two levels. The first is the microeconomic level, which refers to problems within Alibaba's business and operation. The second is the macroeconomic level, minus the already discussed regulations and politics. Let's start discussing the microeconomic level to paint a better picture of Alibaba's financials as a whole. On the surface, Alibaba looks like a no-brainer investment, judged by its fundamentals and, most importantly, the price you have to pay for it. But besides the uncertainty fueled by regulation and political tension between China and the US, there are also operational problems that worry investors. The biggest worry is Alibaba's cloud. When Amazon's cloud service AWS started to become more and more important to Amazon, investors hoped and expected that Alibaba's cloud could have similar success. They had a comparable market position within their respective markets, and the cloud market in Asia promised huge earnings potential and future growth. The truth is that after a very good start, Alibaba's cloud experienced slower growth, and a lot earlier than investors and perhaps Alibaba itself expected. Its margins also fell short of investor expectations. It's currently the fourth largest cloud provider globally, and while that sounds great at first glance, with a 4% market share, it's far behind AWS with a 31% market share and Microsoft Azure with 25%. And Google Cloud is also in the business, having an 11% market share. Within China, Alibaba Cloud was able to gain the number one spot, 39% of the overall market, but its main competitors are growing. Huawei has already 19% of the market, and Tencent, which has 60%, is also catching up. Maintaining leadership in the Chinese cloud market will be crucial, since it will put the company in a pole position to benefit from a recovering Chinese economy and a cloud sector that is still expected to grow immensely in the long term. Last year, Alibaba Cloud was responsible for 12% of total revenues and 3.5% of adjusted EBITDA, which is like EBITDA but without adding back depreciation. Adjusted EBITDA is a metric that Alibaba uses to adjust for expenses that it considers not reflective of its core operating performance. For comparison, AWS was responsible for almost 16% of revenues and an incredible 67% of operating income, while growing 30% year over year in 2023. This was a relatively weak annual growth rate for AWS. In the first quarter of 2024, Alibaba's cloud revenue share decreased slightly to a little over 11%. Additionally, Alibaba reported a slow year-on-year growth rate of about 3% for its cloud. The company stated that this was caused by a strategy shift to focus on the most profitable parts of their cloud business and cutting down less profitable ones, which results in less revenue but higher profitability. As mentioned before, the cloud market is a typical winner-takes-it-all market, and losing its dominating market position within the Chinese market would make the future development of Alibaba Cloud even more complicated. And Alibaba's main competitors in the cloud market, Huawei and Tencent, were both able to achieve respectable growth. Huawei's cloud increased revenues by 17% in 2023. Tencent doesn't disclose the exact numbers for its cloud, since it's part of the fintech and business service section, but was supposedly the main driver for the business service sector to achieve a growth rate somewhere in the teens. It might have been around 60%, since this has been China's cloud service market growth rate overall in 2023. Whatever the exact numbers are, very clear that both competitors outperformed Alibaba's cloud by quite a wide margin. However, Alibaba Cloud's core product supposedly grew by double digits, and adjusted EBITDA grew 49% year on year because of the higher impact of profitable product. If this becomes a trend over the coming quarters, Alibaba's cloud could once again become a strength instead of a disappointment. I consider the cloud to be the main catalyst for Alibaba on a microeconomic level. Other businesses in Alibaba's ecosystem perform well and they are growing quickly, but none of them excite investors enough to change the narrative. Two of those businesses are the international digital e-commerce and China smart logistics, Alibaba's logistic arm. Each of them makes up around 11% of revenues, just as the cloud, but they show growth rates of 45% and 30% year over year, respectively. These are the growth rates investors would like to see with the cloud, since there's a lot more earnings potential in the long term. Also, both segments are not yet profitable, and thus, currently, growth does come at a cost. The main driver of profits and cash flows remain the Chinese e-commerce platforms Taobao and Tmall. That's why investors mainly focus on those two when earnings are reported. And this part of the business, just like the cloud, went through a couple of quarters of slow growth, mainly because of a slower than expected recovery from COVID and a weaker consumer in recent quarters. Year-on-year growth from Q1 of 2023 to 2024 has only been 4%.
Alibaba's cloud really has been disappointing in recent history. Why do you think that has been the case? Is it a problem within the Chinese cloud market or a business problem on Alibaba's side?
Well, that's a great question. If we look at the numbers, it seems to be a bit of both. We first have to understand that the Chinese cloud market is different from the American market. In general, there are three main types of cloud services: infrastructure as a service, platform as a service, and software as a service. Infrastructure services are offerings in which the cloud provider supplies the client with on-demand access to computing resources such as networking, storage, and servers. Within the provider's infrastructure, the client can run its own platform and application. This provides a flexible hardware resource that can scale depending on the client's storage and processing needs. Platform services are offerings in which the cloud provider gives the client access to a cloud environment to develop, manage, and host applications. The client also has access to a range of tools through the platform to support testing and development. The provider is responsible for the underlying infrastructure, security, operating system, and backups. Lastly, software services. They are the best known cloud offerings. The provider gives the client access to their cloud-based software. Instead of installing the software application on a local device, clients can access the provider's application using the web or an API. While it's not important to understand the technical details here, knowing that there are different types of cloud offerings is important to understand the differences between the Asian and the Western cloud markets. We'll get back to this in a minute. The reasons for the bad cloud performance from within the company are hard to pinpoint, but judging from the repeating changes in the leading position of the cloud segment, it's obvious that there will have been problems. While it's unclear how this affected the business, I'm pretty sure it had a negative impact, even if it's just the lack of direction or a shared strategy. The now changed course towards the core products and profitability is another indicator for this. On a macro level, the slow economic recovery after COVID caused companies to decrease their expenses, which also resulted in fewer investments in cloud services. In 2022, the Chinese cloud market only grew 10%. However, last year growth did accelerate to 16% and from 2025 to 20. However, last year growth accelerated to 16% and from 2025 to 2032, growth is expected to be in the range of 20 to 25% annually.
But it wasn't only growth that slowed down. The margins also contracted due to price reductions initially started by Alibaba in April of 2023. Tencent and Huawei followed suit and decreased prices too in order to attract more customers.
That's right. And in February of 2024, Alibaba actually announced another 55% price reduction for many of its core cloud products. I think this strategy makes sense in the long term, considering the accelerated growth rates and the potential of the Chinese cloud market. Attracting a big customer base now can prove valuable in the future when there's the potential to raise prices again. And despite the price reductions, as mentioned earlier, Alibaba was able to improve the profitability of the cloud significantly by cutting down the low margin products. However, the most recent price reduction can obviously impact the results of the next quarter or two. But price reductions are not the only factor in the comparatively low margins of the Chinese cloud market. Now it's time to return to the cloud market composition that we touched on a minute ago. While 80% of the public cloud US market consists of software as a service and platform as a service, the Chinese market is dominated by infrastructure services, which make up about 74% of the market. And these cloud services offer significantly smaller margins.
Do you know why these differences exist?
Well, there are two main reasons for that. The first one is the development of the digitalization of records. For US companies, the digitalization cycle looked something like this. At first, everything was analog and on paper records. Then it naturally evolved to documents getting saved online. These online documents were turned into data, which led the way for complex IT systems like the ones from Microsoft, IBM, Oracle, or SAP. With data already stored in these IT systems, the infrastructure was already there, and the cloud demand was mainly for platform services and software service applications. In China, however, many companies, especially small and mid-sized ones, are still storing their documents in paper form or online without any accessibility to the average employee. Naturally, the next step now would be the introduction of IT systems. But considering that cloud services have taken over large parts of the market, many companies immediately use cloud services. However, without the same foundation as Western companies, they have a focus on infrastructure application. The second reason is the historically low operational cost, and especially the cheap labor in China. As a result, manual labor has been the more cost-effective alternative to cloud services for a long time. Chinese companies also prefer one-off or upfront payments instead of recurring cost models like SaaS services. This is likely to be a cultural thing, but of course, recession fears also play a role in there. If you pay upfront, you can either afford it or you can't. If you enter into a subscription model, you might be able to afford it now, but in worse times, it could be too expensive. But the obligation to pay would be still there. These are some of the underlying reasons for the difference in the cloud market.
We've mostly discussed risks and narratives that cause the stock to struggle in past years. Yet we've said that it looks like a bargain from a fundamental perspective. Considering all we've discussed until now, what are the factors that make it so attractive in your view?
That's a good question. Alibaba's biggest strength are its balance sheet and its ability to generate cash flow. Alibaba has a cash position of over $85 billion. If we subtract the current and non-current debt and borrowings, we end up with almost $62 billion in net cash. On top of that, Alibaba has another $85 billion in retained earnings. If you combine net cash and retained earnings, that's $147 billion on a market capitalization of $195 billion. So there's plenty of potential to buy back shares or pay dividends in the future. Actually, Alibaba started both in recent quarters. In terms of cash flows, Alibaba generated $25.3 billion operating cash flows from Q1 of 2023 to Q1 of 2024, of which $20.8 billion came out as free cash flow. The biggest cash outflow has been the repurchase of common stock with over $12 billion. Alibaba started its stock repurchase program in 2022 and has since bought back stock for $22.5 billion. However, Alibaba has relatively high stock-based compensation. In the same time that they bought back those shares, they also gave out shares worth $10.8 billion. This has been the case before. Alibaba has declared buyback programs of up to $10 billion, but they weren't fully utilized, and thus the stock-based compensation and the buybacks more or less balanced each other out. This time, it looks like the authorized $25 billion buyback program will be fully exhausted. Since authorization in 2022, the share count declined for the first time and went from 2.65 billion to 2.4 billion. Share count decrease of almost 10%. If Alibaba's management continues on this path, the buyback program will have a positive impact on the stock price sooner or later. They've already authorized another $25 billion for share repurchases up until 2027. Combined with the rest of the latest program, this results in $35.3 billion available for repurchasing stock just in the next 3 years. If fully utilized and at current valuations, this would result in about 18.5% of outstanding shares repurchased before accounting for future dilution through share-based compensation. As we will see in the valuation later, with these fundamentals, Alibaba would even be cheap if we assume that growth will not regain traction and it remains in the low single digits. But this is where one of the most discussed arguments from Alibaba bears comes into play. The question of how safe these assets of Chinese companies truly are. The regulation did show that the Chinese government can, if they want to, issue fines, freeze operations, IPOs, and perhaps even assets. Some argue that while Alibaba's balance sheet might look great, this could change quickly when Alibaba somehow falls out of favor with the Chinese government again. While this is the worst case scenario and unprecedented considering Alibaba's size and importance, I believe this or a similar scenario is what scared the majority of international investors out of Chinese stocks. And considering the regulatory actions that we have seen, this might not be as much of a stretch as I would have thought prior to what we've seen in recent years. The rational argument would be that this makes little sense for the Chinese government since such a scenario, especially with one of the best known and most important Chinese companies, would actually weaken China's economy and society substantially. However, some of the regulation that we've seen, for example the Didi situation, already prove that the Chinese government is willing to substantially hurt a company with all the macroeconomic consequences that are connected to this. Although it has to be mentioned that Didi was on a much smaller scale, and what I think is the most important factor is that sanctioning Didi's IPO primarily hurt shareholders, not Chinese citizens. Didi might as well have been chosen because it has such a huge media effect without lasting consequences for the Chinese economy. And while potential investors obviously prioritize the shareholder view, I think the smartest way to view Chinese investments is to take a look at what consequences companies and regulations would have on Chinese citizens. And wherever these interests of shareholders and Chinese citizens overlap, that's a good place to be. Hurting Alibaba in a way that trickles down on consumers is a lot less likely than hurting Alibaba's shareholders. Thus, the regulation that we've seen doesn't seem as random as it might have looked at first glance. There were hardly any regulations that would have had consequences for Chinese consumers. The consequences for shareholders, however, were enormous due to the focus on regulation and communication that hurt the reputation of these companies from a capital market view. $6.3 trillion. That's the estimated number of wiped out stock market value since the peak in the Chinese market in 2021. And the vast majority of these losses are directly linked to policies the Chinese government deliberately made, fully aware of the consequences.
To give the listeners a perspective of this number, since dealing with the likes of Apple, Microsoft, and NVIDIA might skew the perspective here, the combined market capitalization of the leading stock indexes from Germany, Italy, and the UK is roughly $6.8 trillion. Now, imagine that 93% of the entire value of these three market indices is wiped out. This is the amount of money that the Chinese stock market lost in the last 3 years.
Mind-boggling to think about it that way. The question is, will this reverse? Can the Chinese stock market, can Alibaba get back to its old glory? Let's talk about valuation and a possible future for Alibaba shareholders. I think the best way to start is to use one of the best known valuation tools in the financial industry, a discounted cash flow analysis. I know that this model has many flaws, among others due to the amount of assumptions that you have to make and the massive impact single inputs like the terminal multiple can have. However, I do think it can be helpful when the results are as clear as they are in Alibaba's case. I also use 3 scenarios, a base case, a bearish case, and a bull case, in order to get a better idea of what can happen to the stock depending on a range of outcomes. For anyone not knowing how a DCF works, let me explain it very quickly. In a DCF, you discount all the future cash flows you expect the company to earn in a specific period, often 10 years, back to today. The discount rate you use is, of course, a crucial input here. And there are many partially complex ways to come up with the discount rate. Banks usually use the weighted average cost of capital, the so-called WACC. Buffett once said that he uses the 10-year US Treasury rate. I personally use my annual return goal. I do this because this allows me to use the same discount rate all the time, which makes the results better comparable between different companies. Also, this is naturally a relatively high rate, which makes the result even more conservative. Now, before we discuss the results, I have to give you a short disclaimer. Do not focus too much on the precise numbers. These are not price targets. Use them as a compass that shows you the most likely direction if the assumptions of the case are met. Okay, let's get in. My starting point is the current free cash flow of roughly $20 billion. In my base case, I expect a 4% growth rate over the entire 10-year period, a terminal multiple of 10, and a discount rate which is naturally pretty high at 50%. This results in a value per stock of $190, or an upside of almost 140% compared to today's price. In my best case scenario, I assume that China's economy actually recovers faster than expected. I therefore assume 10% annual growth over the next 5 years. From year 5 to 10, I increase this to 12%. I do this since in the best case scenario, the cloud will start growing again and can become a significant part of Alibaba's business and cash flows. These numbers would also shift the sentiment, and I assume a terminal multiple of 20. This gives us a value per stock of $412 or 450% return. In my worst case, I assume zero growth over the first 5-year period. Over the second 5-year period, I did something that I've never done before, just to show you how cheap Alibaba currently is, measured by cash flows. I assume a decline of 2% per year. The terminal multiple is 5. Despite these inputs, this still gives us a value per share of $120. That's a 50% upside from today's price. So from a fundamental point of view, Alibaba seems dramatically undervalued. However, we've spent quite a good amount of time discussing the political and regulatory situation surrounding Alibaba. And as I said in my introduction, this is a very important part of Alibaba's stock analysis. Since this is quite complex and many possible factors influence an investment decision here, it might help if I elaborate on my thought process and weighing of factors. First of all, this is kind of the foundation. I do hold the general belief that sentiment can change a lot quicker than people would previously imagine. As fast as the money flew out of China when the sentiment got worse and returns were bad, as fast will money flow back into the market when the sentiment or the economic outlook changes, which results in better returns. As always, no one wants to sit on the sidelines when everyone else is making money. It's the good old Buffett wisdom. It's not greed that drives the world, it's envy. Secondly, I believe that businesses that are massively mispriced will reach their fair value sooner or later. The larger the company, the sooner it should happen. But don't get me wrong here. A fundamental undervaluation does not necessarily mean that Alibaba is in fact mispriced. I do believe that the market is fully aware of Alibaba's fundamentals, but it chooses to focus on the narrative of uncertainty. And I think that's fair. However, China has a history of very strategic and long-term planned politics. And if we take a look at the results of the regulatory circle that we've discussed, there was very little tangible impact. We have $6.3 trillion of value wiped out versus a few single-digit billion-dollar fines. The big risk of ending the VIE structure did not originate as a threat by the Chinese government, but rather as a narrative of Western investors. So, in the end, very few of the fears that investors rightfully had did materialize. Instead, the narrative changed every time it became clear that the old narrative did not play out. The current narrative is about the China-US trade war and the tensions between China and Taiwan. Once again, very legitimate concerns. In today's episode, we have mostly focused on regulation because that's something concrete that we could analyze and see its consequences. These new narratives are mostly based on speculation. Personally, I consider the China-US trade war to be the less relevant narrative of these two, not because it won't have an impact, but I think the range of possible outcomes is larger, which makes any forecast worthless. What is clear is that there is the potential for a long-term drag on the Chinese economy. But China knew this would come and they will have prepared accordingly. A look at the Chinese trade balance also shows how well they are connected globally. In today's age, other countries are way more dependent on China than the other way around. Thus, potential pressure from the United States towards other countries to stop trading with China is less effective than it used to be. And with their technological progress, I think bans like the US's semiconductor ban are only short-term hurdles and perhaps even speed up the process of China making their own. From an investor's perspective, I consider the Taiwan situation to be the bigger problem, mainly because finding a way out of this situation is difficult. In 2021 and prior, China's opinion on Taiwan was the same as now, and investors didn't care. So the best case scenario would be that China slows down on its public pressure on Taiwan and the situation calms down. Any other scenario is a bad scenario. Even if nothing more happens, with the uncertainty in the air, this could lay like a shadow over the Chinese market, preventing a positive outbreak and causing opportunity costs for investors. In the end, both the China-US trade war and the Taiwan conflict fall on the too hard pile for me. I don't know what will happen. I can only assess worst case scenarios and the results for Alibaba. After doing that, it's just about how comfortable one feels with taking that risk. And that's a pretty good description of what an Alibaba investment is about. Are you willing to take the macroeconomic risk to buy a very cheap company with a strong fundamental margin of safety and the potential to surprise huge on the upside if sentiment changes. There is no right or wrong here. It's about the individual risk tolerance. Shawn, do you want to add any last words to this?
Sure, Daniel. Generally, I feel like all the negative sentiment and risks often overshadow Alibaba's best argument, its price. Alibaba's price, combined with its fundamentals, offers a margin of safety against many of the risks that we have explained in detail in today's episode. That said, as a matter of principle, I try to avoid Chinese companies, but I don't hold it against investors who do look for opportunities there. The frustration with Alibaba is understandable, especially for long term investors who have been invested for most of the downward journey. However, investment decisions always have to be made with fresh eyes. Prior gains or losses shouldn't really be a factor. And at today's price, it seems like a lot of that negativity is already priced in. Apart from the worst case scenarios that you've mentioned, namely a direct conflict with Taiwan and the US, it's totally understandable that many investors put Alibaba in their too hard bucket given the geopolitical and regulatory risks.
Well, I had a lot of fun. I hope you all did too. Alibaba's case is complex, but I think that's exactly why investors can learn so much from it, independent of whether they would invest in Alibaba or not. With that said, I hope you enjoyed this week's episode, and I will close with a quote by one of today's protagonists, Charlie Munger. Microeconomics is what you do, macroeconomics is what you put up with.
Yeah, thanks for that quote, Daniel. And it's been really great to have you on to co host today's episode. I know a lot of people will find this case study on Alibaba really fascinating. I just want to thank you for your time. And I'm happy to say that Daniel will be joining us for a couple episodes ahead in the future to do more company breakdowns.
Well, first of all, thanks for having me. I had lots of fun, and I hope you all enjoyed the episode, and I'm looking forward to the next one. Thank you.
We'll see you guys again real soon. You can make a lot of money investing in a company, even if it files for bankruptcy, as long as the assets are worth more than the liabilities. Ackman recognized this and bought into the company, hoping that it would go into bankruptcy, where it could work out a deal with creditors and sort through the true value of its assets, which he thought exceeded the value of general gross liabilities. That would leave plenty of meat on the bone for equity investors, but the market couldn't see it at the time.